Price. That's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Hector McNeil is one of the most influential ETF experts in the industry, the product of over 19 years' experience. Having been instrumental in establishing Susquehanna's European ETF desk, Hector joined ETF Securities as joint managing partner in 2005. Then in 2011, Hector founded BoostETP. The company was subsequently purchased by US ETF provider WisdomTree in 2014, and 2 years later, Hector stepped down as Co-CEO of WisdomTree Europe to found HANetf. This serial ETF entrepreneur poured his wealth of industry knowledge into Europe's first independent white label ETF platform, the home of 22 ETFs, with 9 of those forming the most extensive Thematics offering in Europe. Hector and I focus on one of those funds, HANetf's all-new enterprise software fund, Europe's first pure-play Software-as-a-Service ETF. Hector explains why SaaS is one of the most compelling investment trends on the planet right now, and how, like never before, investors outside the US can get exposure to it. Enjoy the episode.
Welcome to the podcast, Hector. It's great to have you on the show. Have you had a busy week so far?
Yeah, well, just came back from holiday last night, so I got back in late, and been about 2 years since I've flown anywhere. So yeah, it was a bit of a weird scenario, really. So yeah, no, thanks. It was pretty good.
Yeah, great. You were over in Cyprus, you were saying. How hot was it over there?
Yeah, I was over in Larnaca. Yeah, no, it was red hot. It was between 35, 40 degrees every day, pretty still, which was a bit of a change from here, but nice, good food, good company. I live in North London, where it's very heavy Greek Cypriot community. So every second one of my mates is Cypriot. So saw half of North London over there as well, which was quite interesting.
Yeah, great. Very jealous, to be honest. I need to get away soon. All right, then. Well, let's start with a question that won't necessarily flow chronologically, but will give listeners an early indication of one of the focuses of today's interview. And then we'll get into your background and what you do on a day-to-day basis. So in your opinion, why is software as a service, or SaaS, one of the most compelling investment trends out there right now?
I think enterprise software, SaaS, really is at the cornerstone of everything, really. It's one of the underpinners to cloud. Most of the technologies we're running with, today, especially with the COVID work from home liberation, as I call it, because it's completely changed working practices. It's driven in that, and it's very hard to pick winners in these sorts of thematic plays. So having sort of quite surgical thematic ETFs is good from giving you real diversified exposure to that sector. And you just need to see the growth rates of the enterprise software industry. It's got a growth rate compound, about 15%, per annum. Has been for a while, and it's probably going to accelerate as well. So we just think it's a really dynamic, interesting sector at the heart of most of the things that are going on from a technology perspective.
Yeah, and the isolation, I suppose, we've all felt as a result of this pandemic have increased working from home. Those things, I guess, are obvious tailwinds for a fund and a product like this. But do you think this trend predates COVID?
Yeah, I think it does. Because I think we were all sort of, toying with various technologies, and as I said before, cloud's a big enabler for that. I think the sort of accessibility of it now. I mean, I'm old enough and long enough in the tooth to remember mainframes and PCs and how sort of tied to the desk we were. I mean, even a company like Han, to be honest, has gone completely virtual now. We got people all over Europe, who are working from home, or one or two people offices. And there's not that real determination to be anchored to the desk anymore. So I think you have that real ability and to liberate all firms. And I think it's something like software can now reach something like 99.8% of mid-sized firms, never mind large firms. So it's a gateway and opening that's affordable, accessible, and probably the thing that's changed over the last 10 years is very, very scalable as well, which I think is the criticality of it, really. So it's very exciting.
Yeah, great. Okay, we'll completely agree with that, and we'll get into software as a service and the broader sort of tech space later on in the show. But let's focus now on your background. So just to get an understanding of your current and previous roles, just to set the rest of the discussion in context. I think it's safe to say there's a heavy sort of ETF focus, and that's sort of characterized your career to date. And given your early involvement in the industry as well, you're certainly leaving a lasting impact on what at the beginning of 2021 was a market worth over $7.6 trillion. So that's the global ETF market. So, it's not a small space. That's fair to say. So I want to start back in 2005 with your inception of ETF Securities. What inspired you to co-found that business? And can you pinpoint a particular eureka moment, perhaps?
Yeah, it's funny you say, the industry is not small at 7.6 trillion. When I first got involved in ETFs, early 2000, I think the global market was about 300 billion. And Europe was about 30 billion. So, and we didn't think it was a small industry then, to be honest. But my first sort of exposure to it was I set up a trading business called Susquehanna in Dublin, who were, one of the leading market makers, come out of the US and moved to Europe. And one of their heavy businesses was options and ETFs in the US. Right. And that sort of exposed me to it. And it's right at the genesis of the ETF market, really. And we did a landmark deal with iShares at the time. Who were actually less than 10 staff and around about 10 funds. So it was quite a small business for those guys at BGI back in the day. And we guaranteed to make markets in their products and therefore guarantee bid offer spreads on exchange, because you probably know that, ETFs, when they're new, they tend to not have a lot of trading volume. And therefore, it puts investors off getting involved early. But if a market maker will stand up to the plate and guarantee the spreads and the size, it gives investors comfort they can always get in and out, even if the ETF's relatively small. So that was my eureka moment. And then I was sort of, talking to the likes of iShares and other issuers. And there was this really interesting little business that was on the horizon. Two guys working there, Graham Tuckwell and Nik Bienkowski at ETF Securities. And I could see that they had some great ideas and great products, but were really lacking they were a couple of Aussie gents, to be honest. And they were lacking sort of European knowledge, experience, and also they didn't really understand the trading and the marketing side of the business. So I thought it was a great fit for me. And, I sort of imposed myself on them, really. And I said, look, you need me to come in. And, I entered the business as a 10% owner and one of the founders, and I felt that, gold as well was a pretty undervalued asset at the time. And ETF Securities had invented the first gold ETF, back in Australia, and brought it to Europe, Gold Bullion Securities, which is a product here. And that was even before they were in the US, So, and gold, I think, when we first created the first gold ETF, was trading around about $250, $300 an ounce. So it was, people were lining toilets with it rather than investing it, really. So it was, but you could tell it was going to be something that was going to be, very, very interesting, and you could build a whole business on it. So that was the golden moment, or the eureka moment, whatever you want to call it. And it was quite obvious that ETF market was growing, compounding, I think something like 20% a year, and has done for 20 plus years. And also, I always call myself a bit of an ETF Mooney. I'm a bit of a, I live, breathe, and preach about it all the time. And this was a great way for me to have expression of it. And you're probably well aware as well that Europe is very light on entrepreneurs in the ETF issuance space. It's mainly big banks or asset managers. So we were a bit of a strange beast, really, being guys who got together and created a business from scratch. And we took that business from 0 to 30 billion of assets over time. And as I say, invented things like gold ETFs. One time we had so much gold, I think we would have been the fourth largest central bank position in the world. So I used to call it the People's Central Bank. That's what I used to call the gold ETF, because it was that sort of liberating. So you're right in the middle of it. You're in a growth market, and you're bringing some really great IP and content to the market, and that's what I love, really. And we've continued to do that to today, really.
Yeah, I mean, that point around people in Europe are kind of, there's less entrepreneurs in this space, and there might be, for example, if you were to compare to the US, I mean, we've had numerous sort of ETF entrepreneurs. I mean, they do other things, but we've had numerous people from the US on here talking about their ETF, and obviously the majority of those products aren't unfortunately available to UK-based investors. Why do you think that is? Do you think that's just a cultural thing? What do you think the kind of differentiation is there?
Yeah, I think it is cultural and structural. I think culture-wise, the industry so far has been dominated very heavily, by the banks and asset managers. And even though we talk of Europe as a homogenous, place, and even more so prior to Brexit, obviously.
Yeah.
It isn't really. Obviously, Europe's 30 plus countries, lots of different currencies and languages and taxes and cultures and social mores and all those types of things. And for all things like UCITS does give you a common attack point. There's still a lot of holes in the road. And when the US guys look at Europe, they sort of tend to try and look at it through the same lens as the US. Where it's one market, one currency, one language, all those types of things. And also Europe's a little bit further behind, right? We're 3 to 5 years behind the US in terms of AUM and growth. Even though Europe's twice the population and a similar wealth demographic, that you just think it's just a matter of time before Europe catches the US up. And I think structurally there's significantly more barriers to entry in Europe than there is in the US. I mean, you've got you have to have more listings. You need bigger teams across Europe, etc. You've got more places to navigate. And I just think that probably has put people off to date. I mean, funny enough, there is plenty of entrepreneurs in what I call the ecosystem of the ETF market. Things like index providers or data managers, these types of things. But actually in the issuance side, it's pretty limited. And actually, I suppose that's probably one of the reasons that, the US has developed as well, is that there's a lot of facilitators there now who carry a lot of what I call the spades and shovels to get involved in the market, whether that's the issuance side, in terms of the admin and custody or the marketing or the sales. There's plenty of third parties who are offering those services now. So if you've got a good idea, you can get it to market. And there's plenty of people succeeding in the US with a handful of funds, whereas, you're pretty much doomed to failure in Europe if you don't have a meaningful platform, really.
Yeah, no, absolutely. I think that's a really interesting point. And if we just move on then through your career, I suppose, I think it was 6 years later, in September 2011, you found ETP Management LLP, which later becomes BoostETP, I think. So what was the focus of Boost in terms of products?
Yeah, again, when we left ETF Securities, Nik and I left with a month of each other. We didn't leave as shareholders. We were still under fifth of the company, but we just felt as employees it was time for other guys to take the baton and for us to go and do something new. And we felt it was a bit of an opportunity in the short leverage space, a bit like Direction or ProShares in the US, who've specialised in that space. It's quite a technical product, a little bit riskier. You need to know a little bit more about what you're doing. Probably more the Ferrari high performance end of the ETF market versus the sort of easier Delta One end. So, but also what attracted us to that side of the market was higher fee, lower competition type area. And we felt that it was a real good area for someone to specialize in. And, short leverage actually, funny enough, wasn't invented in the US. It wasn't invented by ProShares or Direction. It was actually invented in Europe by Exact Fonder in Sweden. They brought the first one out in 2005. So they've been around here for a while. And we all know that Europe's, full of structured products and, certificates and, obviously CFD, spread betting, which you guys know very well. So we felt there was a natural, demand for, maybe a listed leveraged product that was maybe a little bit more benign in terms of lower leverage than, say, the OTC markets. So, and we felt that, having a specialist provider, because, the likes of ETF Securities and Lixor and, Deutsche Bank, they all had, leverage products, but it wasn't, it was almost like the ugly cousin in the loft. They didn't promote it or push it. So we felt that, if somebody was out there educating people and, specializing in it, there could be a strong growth. And we also knew Italian investors were very keen on them. Right. So we focused quite heavily on the Italian market. And I think if you looked on the ETC or ETM market in Borsa Italiana every day, you'd see pretty much mine and Nik's products. We did them at Boost, WisdomTree or ETF Securities. They're the top 10 every day. So, people, those guys get it and they love it and they take them on. so that was a great way for us to, Nik and I to go on our own way. We were 50-50 venture between us. Second one we'd done together, and it was a great success. We really enjoyed it.
Yeah, absolutely. Just an interesting point on the Italian market there, because I think because it is quite a complex product, and obviously it comes with a higher risk profile as well. It's sometimes misunderstood, particularly in the UK, I think. So what do you think it was that the Italians got that, for example, the UK market didn't?
Yeah, it's an interesting question, really. I think obviously the UK market, has got a big penetration with CFDs and spread betting. So I think you've got, to some extent, a lot of the more sophisticated demand was catered for with that. And we actually know that, a lot of the leverage ETFs and ETPs are traded on leverage through CFDs and spread bets as well. So, a lot of people get access to it from there. I think the Italians much more prefer to trade on the exchange than probably UK investors. So they were very, big fans of the Borsa Italiana and, listed products, whether that's their, financial advisors or retail themselves, and I think they were very used to trading, the turbos and certificates and things like this. And quite clearly, short leverage ETFs were a good step up in terms of easier to understand and a bit more robust from a counterparty risk protection, I think. So Italian investors have really always got them and understand them. So, and I think the UK, as I say, a lot of that demand is catered for, I think, through CFDs and spread bets.
Yeah. Okay. Absolutely. Well, then in 2014, I think Boost becomes WisdomTree Europe. So you might have to explain sort of that transition to me. I think. Yeah. I mean, I've worked with WisdomTree in the past, and they've always kind of seemed quite US centric, I suppose. So was this the kind of the European arm of a US company, and you helped to found that? Is that the kind of way it played out?
Yeah, it's quite interesting. So we were really going on our way. I think we got to about $1 billion of assets in Boost, and a gentleman called Bruce Levine, who was actually the vice chairman of WisdomTree. He was the guy I actually dealt with, who was at BGI when I was at Susquehanna, and he was headed up the iShares business in Europe at the time, and he'd moved up to WisdomTree. And those guys were looking to enter Europe. They had two monster products, DXJ and HDGE, and they were currency hedged Europe, and apparently I think it took about 30 billion of assets in 2 years on those products, and they became global successes. But the problem with the 40 Act structure in the US is, for quite a lot of global investors, it's quite a negative tax wrapper. So things like you have to fill out W-8 forms to get your withholding tax. The gains on any of the FX forwards inside the ETF have to be paid out as income, for 40 Act products. So, most people don't like income, because it's usually taxed more heavily than capital gains. Whereas UCITS, doesn't have those wrinkles really. And so WisdomTree needed UCITS offering for these ETFs, but they didn't have any staff in Europe. They knew us guys, and they said, well, why don't you, you've got a team of 20 plus people, you've got all the bums in the right seats, and we want to launch quickly, and we want to basically a team in place. So we did a JV effectively. So they injected about $20 million of capital. We injected Boost, and we co-owned WisdomTree Europe with WisdomTree. And we built out their UCITS platform to sit alongside Boost, and then after a couple of years, they bought us out of that business. So again, it was, I would argue, our third, brand and business that we'd created from scratch and sold, and so it was a great experience from that perspective. But it was, I think for the first year of running WisdomTree Europe, we didn't have any member of staff from the US team, and then they obviously gradually came over, and it made sense for them to take it under their own umbrella over time. And obviously for us to hand that over. So a great experience, great firm. They started early 2000s, with a similar sort of time we did it. ETF Securities, we knew them well from those days, and they were from day one focused on smart beta. We don't like doing the Me Too products. We're not the Eurostocks guys, 2 basis points cheaper than the last guys. That's not our gig. So it was a good fit. We built a good business for them, and then they took it over. And ironically, they then bought the ETF Securities European business once we left. So it's like quite a few of our creations were all coming together in one, really. So it's quite an interesting world, really, from that perspective.
Yeah, well, almost sort of confirmation of your success, really, in terms of those businesses being brought together by WisdomTree. That's fascinating. So that was 2 years later, I think, that you then set down as sort of co-CEO to establish HANetf, which is obviously your current business, the one that you run day to day now, again with your business partner, Nik Bienkowski. What did you think you could do differently at HANetf that peers in what is, I suppose, at this point, an increasingly competitive ETF market? What did you think you could do differently to those people?
Yeah, it's a good question. So Han stands for Hector and Nik. It's not like the Han dynasty or anything like that. even though we do want to create that sort of dynasty. But Nik and I, obviously once we've exited a few businesses, the thought process was, well, you want to do something different, or would you carry on? But as I said before, both of us are ETF Moonies. We love it. We're mildly obsessed with it, and we still think there's still tons of growth, particularly in Europe. We think, as I said before, Europe's a little bit behind the US. If you think about it, an ETF is really, an advance of a mutual fund, right? It's not something standalone or different. It's really just, akin to mobile phones versus landlines, or diesel versus electric cars, right? It's the next stage. But we just believe, from a consumerism perspective, the ETF wrapper will essentially take over all sort of daily liquidity exposures over time. So you won't get things like private equity or property in there. No, I mean real property, not REITs, because obviously you do that, but real physical property, because obviously that's not daily liquidity. But everything else should end up in the ETF wrapper, whether that's active or smart beta or thematics or plain beta or whatever the story is. People often conflate ETFs with beta. It's just a wrapper at the end of the day. And I just believe, from a modern consumerism perspective, the only thing that's going to succeed is the ETF and not the mutual fund. I always say my son is never going to own a checkbook. He's going to want to do everything on his phone. He's never going to fill a form and wait a week to get a price, right? Which is what you have to do in the mutual fund world. And he wants Amazon Prime gratification. And ETFs give you that, right? So you can put it all in one place. You can have all your positions, and we just felt the sort of next stage of the ETF market. So the beta side had been won. The iShares, the supermarket guys had won that. It's all about cost, but low on IP and content. So we felt the next growth of the ETF market would be in the sort of high content, sort of high track record type part of the world, but probably not needing to have the same sort of supermarket range available. So I always say iShares is like Walmart. You can turn up and buy a box of strawberries or a pack of bacon or a pair of jeans or whatever. It's probably not going to be the best, but it'll be good enough. And you don't check the website before you go, because it'll be there. So our vision of Han is to be the sort of first multi-manager ETF platform. So go heavy on content, track record, and be the first sort of multi-manager platform that's available out there. And and I think we needed to answer the question that, if you're sitting next to a gatekeeper in a wealth manager or private bank or a brokerage platform, and they say, well, I've got 20 ETF firms, why do I need a 21st? We needed to be able to say, well, we're going to do different things, So we focus very heavily on thematics, cryptos, active, smart beta, niche type places, and so far so good. It's we also believe that sort of end of the market, it doesn't make a lot of sense for those type of asset managers or brand owners to invest in all the spades and shovels that you need to issue ETFs and manage them. At the end of the day, we think it aligns very well. The Han does all the heavy lifting, and the client looks after the content and the strategies. And the two go together very, very well. So I use an analogy of iShares being Walmart. We see ourselves more like Whole Foods. The delicatessen, high value. Yeah. So we essentially provide the shelf space, the beautiful shop and everything like that, and the customer experience, and the clients produce, give us the produce to put on those shelves. So the best pizza, the best milk, whatever it is, and I think we've been in the market for less than 3 years. We peaked at $2.5 billion of assets earlier this year, which is unbelievable. I think we're the fastest growing ETF firm in Europe, and we've got probably the most dominant thematic range and crypto range. And we pretty funky things like we've done, a gold ETF with the raw mints. You're probably well aware that a lot of gold bugs don't want to hold gold with banks and financial firms because they're trying to hedge that financial systemic risk. So to have a sovereign mint holding the gold, that's Britain's oldest company. It's been around for 1,100 years, and Alfred the Great set it up in 886. Is a little bit of a different proposition, and that's where we're coming from with HAN. We're not the cheapest. We don't propose have that aim or motivation. We want to be heavy on content.
Yeah.
Every one of our ETFs gets a monthly report. So the clients all produce a monthly report that backs up that ETF. So I don't think there's any other issue on the planet that does that. So you get an up-to-date macro and micro view of what's going on inside the ETF, whether that's constituents or industry news or regulations, whatever it is, and you've got that. That goes straight into the investor's hands or the advisor's hands, so they can be right up to the minute in terms of what's going on. So that's where we've tried to differentiate, really, and I think so far so good, really.
Yeah, I mean, absolutely. I think if HAN is the Whole Foods of the ETF industry and that wider space, you've certainly got a well-stocked thematics aisle, I suppose. I mean, you've got funds focused on cloud technology, healthcare innovation, clean energy, and that's just naming 3. There's plenty more in there. So I wondered whether you could talk to the idea that there might be some sort of guiding principles, I suppose, that govern the focus of these funds, or perhaps to kind of pivot the question, are there principles that relate more to which asset managers and index providers you work with? Like, how do you decide which funds make it into the HAN ETF range?
Yeah, it's a good question. I wish it was as structured as that, to be honest. I'd say the reality is that, we've had 800 plus inquiries from people who want to do ETFs with HAN. I mean, most people who come to us believe they have alchemy, so they believe they've got the, we should do it for free and, it's going to smash the lights out and et cetera, et cetera. What I would say is that, with Nik and I in our careers, we've issued over 550 ETFs and ETPs in our time, which is about 7% of the world's total, which is a big chunk of numbers. And we've recently hired Manoj Mistry as COO, who was the CEO of DWS's passive business, so he's done about another 450. So between us, we account for nearly 12-13% of the global ETF market by number, not by AUM, unfortunately, but by number. So we've got a lot of DNA in terms of what works, what doesn't work in the ETF land. But we do try to weed out a lot of people who come to us early doors through questionnaire. So we try and look at their financial strength, their track records, their expertise. Because a startup can be equally as good as an established company if they've got the expertise and the knowledge and experience behind it.
Yeah.
So we tried to dig into that. In some detail. We have a couple of guys who run business development for us, so they go into a lot of detail. And then once that gets to a certain point, we prod and test the back tests or the structures. We usually encourage them to go and talk to index providers early, so they get that sort of validation and understand what the rules are, liquidity screens, all those types of things. We've got a good spread of work with index providers. We work with the likes of Valerian, Solactive, INDXX, some more the sort of more entrepreneurial end of the market on the index side. But we tend to find they're very good at validating strategies as well, or tweaking them, to be the most proactive or the best returns, or the best structures. So that's definitely been a big focus. But it's quite a long process. Say typically, could take 20 odd meetings, lots of hoops to jump through. Lots of analysis, and then it's got to get through Nik, my business partner. That's his big specialism is product development, and he's probably one of the smartest guys I've ever met. And he can validate something pretty quickly, whether it's going to work or it doesn't work. And one of the guiding principles on the HAN platform is we don't have any overlap either. So we won't have 2 cloud ETFs, we won't have 2 enterprise softwares, 2 medical cannabises. That's why it's really important we get the right partner. So we make sure that we have the best guys behind whatever we're doing. So that's really important to us, and then basically we hold the hands to get this over the line. The aim of HAN isn't to be purely thematics or cryptos, whatever. I want to have 150 funds across the whole chemical table, as I call it, of the ETF market. It's just that we can have a fund out in less than 3 months. And obviously, people are going to come to us where things are very hot, or they need to get something to market quickly. And if you talk to the likes of Manoj who worked in bigger companies, they'll tell you, companies like that can take a year to get things out where we may take 10 weeks. So it just so happens that's where the focus has been really in the crypto and the thematic space so far. You know, and over time we'll broaden, you know, fixed income, more commodities, alternatives, you know, maybe even some core equities as well over time, you know, but that's where we are at the moment. And thematics are great because, you know, at Han, probably one of the overriding principles actually I probably should have started with is actually we love products with a story.
Right.
I mean, I started talking about the gold ETF, you know, I mean, there's 20 plus gold ETFs out there, you know, but, you know, so it's very unlikely you could come up with something new, but the raw mint's a great story. So, you know, you give that ammo to the financial advisor or the investor, you know, and then they can move to the next level. And, you know, we love ETFs with stories, and thematics obviously, you know, really lean into that very heavily, you know, because they do tell stories. And I think a lot of people think their retail investors should be wary of them because they get carried away with a story. But I disagree with that. I think they're actually quite liberating for retail investors because, you know, as an industry, we're very heavy on terminology and science of what we do. You know, but if you talk to investors about growth, momentum, or value, or you know, all these technical terms, you know, they don't really understand that. They don't get it. But they all have a view on thematics. They all have a view on, you know, aging populations, work from home. There's an almost instinctive view on these investments, you know. And I'm not saying that they need to put 100% of their portfolio in these products, but I think they have a view, and I think that that's quite good and healthy in my estimation. So if you're going to put a couple of percent of your portfolio in cloud because you live and breathe it, you use it yourself as a personal day-to-day basis, I think that's a really positive thing to make a decision like that and say, well, actually, I think, look, this is only going to go one way over the next 20, 30 years, rather than, you know, a financial advisor saying, look, I think, you know, the market's going to move from value to growth, you know, and blah, blah, blah. And, you know, you don't really have much of an idea what's going on. So I think they're pretty liberating from investors from that perspective.
Yeah, I completely agree. We do a lot of work on Opto, on thematics, just because we do cater predominantly for a retail base, and the fact that these are so much more intuitive, and the narrative behind some of these is so much more compelling than, you know, a sector rotation ETF or a factor-based ETF. Yeah, it really gives us a lot of content to work with.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
And just one more question on kind of the range as a whole. I noticed some of the funds are essentially UCITS counterparts or versions of popular US ETFs that will actually be familiar probably to some of the listeners. So you've got the likes of the Procure Space ETF, you've got US Globals ETF. I mean, these companies, I suppose, are approaching you saying, we've had a lot of success with our ETF in the US. We want a European version. Is that typically how that process runs?
Yeah, it is. I mean, it's either we get in touch with them or they get in touch with us. I mean, you know, we used to go to in normal times, we used to go to a big event called Inside ETFs in Florida, and it's a big meeting place for the whole industry. You know, but certainly, you know, I buy EMQQ, Jets. You know, it's been a real chance for, you know, relatively parochially US firms, you know, who actually, you know, would really struggle to get a footprint in Europe, and you know, scares them, or, you know, it's going into the unknown or overstretches them, and you know, this is a really neat solution for them because they can lean on, you know, repurposing all the content they've got. They've probably had you know, global investors come to them and say, look, you know, out of China or Asia or Israel or South America or whatever, or Europe, and said, look, you know, we like your fund. You know, MiFID's not allowing us to buy these anymore. You know, we can't do Prips and Kids, and, you know, all a bit of a minefield, you know. So actually, you know, having, I actually think if you've got a global brand of a product, you really need UCITS and 40 Act standing side by side, and you can pretty much cover any investor in the world then. So yeah, no, it's been a really interesting time with that. We've had some really interesting ones recently. I mean, you've probably seen that, you know, something like our travel, hotel, cruise lines and airlines ETF Trip. You know, that actually almost simultaneously launched in the US and here. So that's a US issue who wants to launch the same time in Europe and the US.
Right.
You know, and we've got a few more coming like that. That's you know, it's not just about, you know, getting a lot of traction in the US and bringing it over here. I mean, you know, something like Jets is $4 billion of assets in the US. You know, it's one of the most traded ETFs there. EMQQ is a couple of billion. iBuy, from Amplify is a couple of billion. So these are all very, very popular and well-known, ETFs and tickers. And we can give these guys a very coherent way to bring these to European investors and others who like UCITS. So I think it's, as I mentioned before, one of the big problems in Europe has been the barriers to entry. We've massively crushed those for these sorts of people and, made it a very, very cost-efficient and time-efficient model, to get out there. And we've proved we can raise assets in it as well. I mean, EMQQ, was at its peak $450 million in Europe, and that was the first ever ETF that we did. So it's proved to these guys that, you can be successful on both sides of the pond and have a relatively lightweight setup to do that. And the great thing for us is they've got years of content that we can just repurpose and, get them on a webinar or whatever it is. And you're not reinventing the wheel all the time, which is fantastic.
Yeah, absolutely. And I'll take this opportunity to point our listeners in the way of our Frank Holmes interview. So he's the CEO at US Global. Talking up jets, I mean, that was the focus of the conversation. It must have been about sort of 6 or 7 months ago now. But a lot of our listeners at the time were UK based and maybe thought that there wasn't the opportunity to get exposure to that ETF. Well, that sounds like there absolutely is. So let's move on now to kind of the focus of today's interview. We've got around sort of 20, 25 minutes or so to get into this. It's the Enterprise Software ETF. SOFT is the ticker. And that's from yourselves, HANetf. Let's first start by just digging into the kind of the philosophy, I suppose, if we put it like that. I mean, this is Europe's first pure play enterprise software ETF. So firstly, that actually surprised me. I mean, given the huge growth we've seen from key players in this market over recent years, did you feel kind of pressure to capitalize on that gap in the market as soon as possible?
Yeah, I think what happens is in that we get out there, talk to clients, and they almost become our best forms of product development, really, because they sort of tell us what's missing, and certainly I'd say enterprise software and semiconductors have been really two big areas that people have talked a lot about, when we've gone out to speak to them, in terms of getting that sort of surgical exposure to and getting that growth story. So yeah, and I think once you've had that sort of, we create Europe's first cloud ETF Sky, and when WisdomTree brought their sort of their cloud ETF out sometime after ours, it had quite a tale of SaaS in there, So we just felt that the next logical step was to listen to that market and say, well, actually, we think there's a really great play in here, and Purpose, the firm behind it out of Canada, they actually run active money in ETFs in this space. And we had long discussions whether we should do an active fund or whether we should do an index fund. And we actually felt for Europe, Europe probably wasn't ready yet for the sort of active story in this space. But actually, a well-constructed index, could do the job very well. And we have a lot of investors who've told us, look, they like our ETFs because they've been sort of heavily involved in stock picking in these sectors, but they've probably made a few mistakes in terms of which ones to do and which ones, how much to invest in different companies. And that just takes this mistake away, really, and gives you that sort of diversified play, cuts down on ticket charges, also the different currencies involved as well through the different countries involved in it. So you do get that sort of, broad diversified play in that sector, and it gives a tool that's been missing from the market, in our opinion.
Yeah, and I suppose it's not just exposure to this particular segment of the market. I mean, you're getting exposure to themes or even mega trends, secular growth themes, even given the nature of the space with an investment in this fund. Can you talk to me about those themes and trends?
Yeah, so as you exactly say, I mean, I think what you're alluding to is, the sort of a lot of the building blocks to, the different themes that are out there. Whether it's infrastructure connectivity or whether it's cloud, whether it's healthcare, whether it's education. You've got the sort of building blocks to that story, and I mean, you do have some well-known names. I think that the largest position is Adobe, which is going to be common to a lot of people. But you have got a lot of names that maybe aren't so well known, like Palo Alto or Zscaler or EPAM Systems. so you're getting a lot of underpinning, as you say, to the mega trends, but you're also getting a lot of interesting companies that are maybe not the household names of today, but are probably going to be of tomorrow. I mean, look at what happened to Zoom over the last 2 years, right? I mean, who would have ever said that would have been the case? And I think that's a great beauty of these types of products. It's a bit like EMQQ, that e-commerce, emerging market e-commerce play. When that first listed, it had less than 40 stocks, I think, and every rebalance it has now nearly 10 new unicorn companies. From Poland or South America or South Africa. So you get that sort of ability to capture not just the theme now, but also the unicorns that are coming in the future. I actually found out the other day, just as an aside, that a $100 billion unicorn is actually a hectocorn. So hopefully Han becomes a hectocorn. But there you go. But no, I mean, obviously the basket is predominantly North American, but you will get companies coming through from Europe and Asia, etc., that will be quite interesting in the future. But no, you're exactly right. It does underpin the whole technology megatrend story for sure.
Yeah, and I mentioned some of these themes and trends are sort of secular in nature. I guess they surpass the sort of cyclical nature of markets. And if you agree, I suppose, on what time horizon do you think people, I don't want to say should typically invest in the product, because obviously that's down to them, but I guess how is this product designed? Is it a long-term investment, do you think?
I think so. I mean, look, you look at some of the areas that are, big stories today, but there'll be bigger stories tomorrow. I mean, you've got telemedicine, electronic signatures, web conferencing, mobile app development, antivirus, remote desktops, video platforms, webinars, portals, live chats, stuff we take for granted today, I was joking to my son on holiday that, his son's going to laugh at him when he mentions Google. He's going to see that like when I mentioned Encyclopedia Britannica, right? So, but I think my view on the sort of the outlook really is at least 3 to 5 years, I'd say, for things like this, because otherwise you just get wrapped up in volatility, market moves. I mean, we've particularly seen that over the last couple of years, haven't we? Where there's been complete upending in the markets given what's happened with COVID, etc. But I think if you just look at this, and that's why I say it's a small percentage of your portfolio, not a large percentage. But I'd say 3 to 5 years is minimum. I mean, the great beauty of ETFs is you can be very tactical if you want to be. Like you think there's going to be some, like you've seen with the COVID crisis. But I would say typically you should be investing for at least for the medium term, preferably for the long term.
So how many stocks does the fund typically hold? Is it quite a diverse array from this particular sector?
I mean, normally we sort of like to have a pretty diverse holding breadth. I mean, sometimes the sectors don't allow it. Like for instance, when we did the medical cannabis product, that originally started out with 13, but it's up to 30 odd now.
Wow.
I mean, this sector is obviously a lot more developed than that. So there's 50 plus holdings in this one, which really is quite a diversified play. I mean, it's 54 actually in this. So, but typically the minimum we'd want is 20 in a thematic play, or I call it a placeholder, like the medical cannabis, where there's going to be more companies in the not too distant future. You can set the product up and then captures them from there. But no, this is a pretty well diversified, and I think the largest holding 7%, and the smallest is 0.5%. So it's a pretty diversified basket as well. There's nothing really that dominant in the holdings. I mean, you can find some ETFs, where 20 to 30% can be one holding, but in this one, you're, and it's not heavily dominated by the FANGs either, which again is what you have to be careful with some of the, the tech related thematics. I mean, you asked about product development earlier. That's one of the themes that we are very strong on. I mean, where we do think there's a potential for a sector to be dominated by those big stocks, and you can be adversely affected by them. We usually go equal weighted. We haven't done that in this one, but we things like our cloud or the health mega trends and We just recently done an ESG gold mine. As you know, we decided to go equal weighted for that, where we feel there's extra diversification needed. But this one's pretty well diversified anyway.
Yeah, okay, great. And it's tracking the Selective Purpose Enterprise Software ESG Screened Index.
Yes,
so
correct, yeah.
yeah, just got through that name.
Yeah.
So what are the most, or kind of what are the key fundamentals or consistent characteristics this index screens for? Is it something like substantial moats, R&D investment? What do you look for in the stocks?
Yeah, so we try to, maybe it's worth just talking about that ESG screen first, actually.
Yes, yeah, absolutely.
Yeah, because that's I think that's the way that the market is going to go now, with regards to even Thematic. So it's important to say it's not an ESG index per se, but what it is a screen for weapons and alcohol related companies, etc. So. And tech obviously lends itself very well with that, but it's essentially taking bad companies out. But it's not an ESG ETF. But I think it does allow investors some comfort that there is some oversight of the index from that perspective. So that's really where it's important in terms of the software index itself. It's really got to have. High recurring revenue growth in the industry, and it's got to be ones that are going to be poised to benefit from, the acceleration of digital, across the board, because it does need to be exposure to that sector, and its strong gross margin profiles have to be, typically between 75 to 80%, and it's got to be on SaaS companies that are going to really benefit from the software trends. Typically on the weightings, we look for a sort of 3-year average EBITDA margin of at least 20%, revenue growth of at least 15%, and a market cap of between sort of $500 million plus type levels. Weightings, we have a 6% cap. Obviously, I mentioned before, the current largest stock is 7%, because that's essentially because it's grown relative to the other stocks during the rebalance. So the rebalance will take it back to that. There's a 1% floor. Again, that will be through the rebalance that's taken out from that perspective. And, we have a liquidity screen based on the ADV from that perspective. And we use a piece of software from a company called Artists, which basically is a sort of an AI scraper that picks up, the top 300 companies in this sector that we then select from on that basis. So, I mean, obviously there's some very, very detailed rules to the index, and people can quite happily delve into them. We try to summarize them. If they go on the website, there's a deck that people can look at, in detail. But we try and summarize it a little bit from there, so they can find more answers to that. But I'd say that's really the summary of what's important for them to know from that perspective.
Yeah, absolutely. I did take a quick look at that link that you mentioned there. So we'll put that in the episode description for people that do want more detail. But I think you've done a really good job of just showing that, this isn't just broad sector exposure. I mean, there is proper thought being put into what companies appear. And then you've got that extra layer of ESG to screen for the bad companies in quotes, which is great. I think it makes it a really interesting product. So let's move on then to kind of the last area. I want to talk about performance. I mean, it's a very new fund, of course. I think start trading in late July. So it's extremely early days there. But Selective's index gives us a good indication, I suppose, of past returns at least, having achieved over 50% in the last 12 months. That was when I looked 2 days ago, so it could have changed a little bit from there. But then over 473% in the last 5 years as well. So pretty extraordinary growth, well above the market. Do you expect that to continue over the next 12 months? Feel free not to be too explicit here with compliance, etc. in mind.
Yeah, I mean, look, I think the fundamentals are very strong. I mean, 12 months is, as we've seen recently, is a short time horizon, and there's a lot of factors that can bear on that. But I think the fundamentals are very strong. The companies are very strong. The underlying fundamentals, and I do believe that like you were alluding to earlier, that COVID in some ways has quickened the trends, but it hasn't invented the trend. So I think we're in that sort of direction of travel. I think the 50% is defendable going forward. I mean, the 500%, that would be hard to promise. But I do think this sector is open for exponential growth for sure. I think as Einstein said that compound interest was the eighth wonder of the world, right? And certainly the compound growth of these companies, will be significant, will continue, and the momentum is very much there. I think I heard from one of my son's teachers a couple of weeks ago. He said that there's going to be more inventions in the next 10 years than there has been in all of history. I think even if that's partially true, there's so many more things that we're going to discover. I mean, you mentioned Yoda, the Pure Space ETF. Who'd have said that would have been an industry, a couple of years ago? I mean, I think 80% of all the investment going to space now is private money, not state funded. So I think it's pretty defensible, and I think it's an area that I think is still very fairly early days, to be honest. And that's even if you look at just the population demographics as well. Whether it's e-commerce or medicine or manufacturing, whatever thing you look at or touches you day to day, is completely underpinned by this sector really. So I think it's got. I mean, I'm never one to say it's going to do X percent or Y percent, but I certainly think that the growth trajectory it's got is defendable and should be a consistent approach for the next. As I said, 3 to 5 years at least, but even on beyond that, I would say.
Yeah, absolutely. I want to finish on a question. You mentioned Me Too products earlier, Me Too ETFs. And I think it's a really interesting way of describing some of the other offerings out there. Perhaps you can just briefly explain what that is and why you think Soft and the rest of HANetfs shouldn't be branded with that moniker.
Well, I think the Me Too description is basically where, we mentioned earlier about there being a domination of big banks and asset managers in the ETF market. And what tends to happen with those guys is they tend to have like captive business, whether that's a private bank or an execution-only brokerage or whatever it is. They've got areas they can have a natural distribution to, which probably means the first thing that group says to them is, well, I need a Eurostoxx 50 or an S&P 500 or a FTSE 100, because that's where my money is going into competitor ETFs. So you tend to find that these ETF providers, when they enter the market and their captive audience says they need these, that's the first thing they produce. So they bring out the core 10 ETFs. And I think we've got this ridiculous scenario where there's over 50 Eurostoxx 50 ETFs in Europe, so that's purely by the fact that, these guys, have assets in these ETFs and they switch it to their own. So that's what I call the Me Too sort of, and obviously when you're 50th to market, the only thing you can really compete on is price. You can't compete on content or IP. It's all about scale and price, and really it's I think akin to banging your head against a brick wall, really. So so that's something we've never got into. So you tend to find when we send out a press release on a new product, it'll stay either a European first or a global first, and that's because that's where we want to be. We want to be in that sort of added value space where we're, if we're bringing a product to market, it's either not been done before or it's better than, significantly better than what exists out there today. And there's a great example of that actually. We brought a version of the iShares INRG, the clean energy ETF. They switched the index because there was concern over the concentration in clean energy stocks, but we think they lost some of the purity of the index with that. So we kept to the 30, the S&P index 30, because we felt there'd be residual clients who would still want that index. But where we brought something I thought quite clever is that we brought the first ETF in the world that sort of calculated the carbon impact of that investment. and then we then take part of the TER of the ETF, and we invest in carbon offset projects to offset the carbon. We've called that Hand Zero. So we've got it on 3 of our products so far. So that was our first, what I would call closest we've done to a Me Too product, where we, did something that's exists out there. I think it's probably the most successful thematic ETF in the world is at INRG. It took, loads of assets, over a short period of time.
Yeah.
But we felt we could do better with it by, not just offering the clean energy side of it, but actually saying, well, 2050 is still a long time away for carbon neutrality. So let's try and get there early and have carbon neutral investment. So we did that. We created that index, the ETF, the ticker Zero, actually, which I think is a pretty cool ticker for the product. And it nets off any carbon impact. So, we believe as a provider, where we add value over above being Me Too, is, you don't wait for investors to tell you what they want. You help investors get what they need. And we believe that, certainly the millennial investors and below, really believe 2050 is too late for the planet, So we brought that Hand Zero. So we piloted it on that product, and also a sustainable active ETF we've done called SESG. And it's also, which obviously retail can't buy in the UK, on our BTC, our Bitcoin ETP. So we feel that's where if you're going to get involved in that Me Too business, the place to be is by adding value and improving on what's out there currently. So it's a bit of a long-winded answer, but hopefully that's got you to where you needed to be there.
Absolutely where we need to be. I think that's a nice message to end the main body of the interview on as well. I've got some quick fire questions here. So the idea of this literally takes sort of 2-3 minutes, and it's a more generic list of questions. They won't be personalized to you, but they're just a light-hearted way to end the episode. And feel free to answer in as little as 1 sentence or even 1 word, if you like. The first question: what do you think the top or most frequent mistake investors make is?
They get in too late and get out too early.
Yeah, spot on. Okay, question 2. Where do you go for investment or economic insights? Do you read specific publishers, for example?
Yeah, I'm a heavy reader of Money Week. I like that.
Yep.
It sort of consolidates a lot of things. I sort of try to read Investors Chronicle, but struggle a little bit more with that. I read a lot on Apple News, so I have a lot of things where I track it there. And then really ETF websites, like ETF.com or whatever. And obviously I wait with a lot of interest to get your newsletters that come through on email on a regular basis as well. So I enjoy that. I actually do enjoy those, to be honest. I think they're pretty good. So yeah, that's where I get it mainly.
Perfect. Nice little plug there for Opto. Point 3 then. What is the most memorable moment from your career to date? This is quite a tricky one.
I think ringing the bell on the New York Stock Exchange floor, actually.
Wow, yeah.
It was quite a funny story, actually, because I'm there with all my my guests, and just as I'm about to ring the bell, the NYSE manager there tells me, he says, "Don't press it twice because it turns off," and they all boo you on the floor. And actually, it was complete rubbish, because if I didn't press it, it goes off anyway. So... what was even funnier is my mum rang me later on that day. Said they were on a cruise in the Caribbean and said, "We've just seen you on CNBC. You didn't tell us you were going to be on ringing the bell." So I've done that twice. That's a pretty great experience, and done something pretty similar in Tokyo as well, which was a fantastic experience as well. So, but I say that made me feel that we've done something quite special.
Yeah, no, absolutely. Okay, penultimate question. If you could go back in time, what would be your top tip for your younger self?
Wow, when how far back?
Yeah, I mean, there's probably multiple ways you could interpret this question. I think usually people go back to sort of when they're in their teenage years, when they're just sort of come into sort of financial kind of security, they're understanding the concepts. They feel as if predominantly they would have done things differently. How about you?
Yeah, I think probably the most thing I would have said is probably start your pension investment earlier. I think the earlier you do it, the more. I mean, obviously the government hasn't made it easy with these caps that they bring in, but again, that mention about compounding. that I mentioned before. You know, you talked about investment insight before. You know, when I mentioned about, you know, getting in too late and getting out too early. You know, alongside that, I've always been a massive fan of pounds cost averaging. You know, because it just means you make less mistakes like that. You know, and that really helps about that getting in too late and getting out too early. You know, you really can control it to a certain extent by pounds cost averaging. So I think you know, getting a pension early, and also, you know, really buy away from big cost products as well. I mean, I had a lot of my pension in funds that were charging 1.5 to 2.5%, and I think if you look at the academic studies, you know, but just by saving 1% a year, you know, your pension pot could be worth 2 or 3 times the value. You know, just by all things being equal, just by saving that that 1 or 2% a year, and that compounding over that time. So, you know, time is a great thing for. I mean, you mentioned about time horizons on products. You know, the better the theme, the longer you can leave it, the more likely you're going to be a winner. Really, at the end of the day.
Yeah, absolutely. Okay, final question. What is an investor's best source of alpha? So if you had to narrow it down to one thing, where do you think the great investors derive their outperformance?
Oh, I think rather than great investors, because obviously if you're a great investor, you probably don't need any help, right? You know, that's probably the long and short of that. I mean, I would say probably diversification and a bit of discipline around. Yeah. You know, limits. I think limits are always quite good tools for investors as well. You know, look at where you're happy to get to, you know, and look at where you're willing to cut your losses. You know, so I'd say diversification and limits are probably the things that you really need to consider in that perspective.
Yeah. Okay. Absolutely. Well, I think that's a nice message to end on. Thank you very much for joining us on the podcast, Hector. It's been a real pleasure.
Thanks very much, Hayden, and thanks for having me.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.
Co-Fruition.